Yeah. Okay, great. Okay. Good afternoon, everyone. I'm Sanjeev Mota from B&K Securities. Welcome all of you to another session of this Fireside Chat. We have with us Mr. Tarun Sawhney, Vice Chairman and Managing Director of TRIVENI Engineering. Tarun has actually, if you see his background, it's amazing. He's done his bachelor's and master's from Cambridge. He's done an MBA from Wharton. So, fabulous background, Tarun. And, Tarun, thank you for joining us for this fireside chat and giving us your valuable time.
My pleasure, Sanjeev. Good to be here.
So, Tarun, the way we'll do it, we also have Rajesh, as you know him. So I'll ask you macro and some organizational level questions, and then Rajesh will has his own questions. And we'll also have, if anyone from the participant has any question, they will put it on the chat or Q&A, and we'll make sure that we ask the question.
Wonderful.
All right, great. So let me start. So, Tarun, when did you join the business? So it's obviously a pretty old business, and your dad has done this for a long time. When did you join the business?
So, I joined the business after I graduated from Cambridge in 1995.
Right.
And upon joining, we still had engineering and sugar as part of the portfolio of the company. And I actually chose to go and live in one of our sugar factories at a town called Khatoli.
Mm-hmm.
And I lived there for 2 years. And I think that was the perfect introduction to the sugar business. There's no better way of learning the ropes. I lived at the factories. I spent time visiting farmers and being offered multiple glasses of unpasteurized milk, which if you have not experienced, it is quite a different taste. But it was a thoroughly enjoyable experience, and one that certainly can't be replicated if you want to go get to know a complicated industry like sugar.
Mm-hmm. Right. Great. So actually, just you talked about that even that time the company had sugar and engineering, and I guess sometime in 2010-11, you all demerged TRIVENI Turbine now, but the power business remained here, like some bit of the gear business remained here, and then you also were in water business. Just trying to understand what was the thought process behind the demerger, and why not the entire engineering side? How did it work?
So you ask a very interesting question, Sanjeev. In the wisdom of the board at that point in time, we felt that it was important to demerge the turbine business. The turbine business was of a sizable nature, number one. It had the ability to be able to operate on itself and to grow, which it has over the course of the last 10, 11 years, fairly substantially, and also to be able to follow its own trajectory and path. The water business at that point in time is very different to what exists today. It's transformed, completely transformed. And at that point, it was a much smaller business.
Yeah.
Water and turbines also have not much in common,
That's it.
to be perfectly honest. Gears does have. Our largest customers are power turbine companies.
Yeah.
TRIVENI Turbine being our largest customer, Siemens being another top customer of ours that buys gearboxes for steam turbine applications. However, our power transmission business caters to many other industries. There are a wide variety of high-speed gearbox requirements that come from pumps, from compressors, from blowers, fans, gas turbines, steam turbines, domestically, internationally. And the size of the company is also much smaller. So if you think about it, a gearbox in terms of the total package of a turbine island and therefore for that company also, we felt that it needed to be nurtured and it needed that ability to be able to grow within the comfort of TRIVENI Engineering.
Right. So does that mean that at some point of time you look to because although they're still not scaled up that much, the gear business, it's still like relatively small. Water business seems to be gearing up, and outlook also looks pretty interesting. But as you said, they're different. What do you think, if I were to look at TRIVENI 5 years, 10 years down the line, would the structure look quite different?
Potentially, Sanjeev, it's difficult to answer. We're a listed company, so these types of decisions have to go to the board, then to the
Sure.
stock exchange. But for the purposes of this conversation, I have to say that yes, the engineering businesses are smaller. They're much bigger than they were 10 years ago. Okay,
Sure.
they're much better structured, and the possibilities of growth in their various directions it's a very concrete reality.
Mhm.
In a post-COVID world, both the engineering businesses are actually doing remarkably well.
Yeah.
And the strategies that we've put into place, and I'm happy to talk about, I'm sure over the course of this hour, we'll get a little more granular. But the strategies we put into place will really transform the shape and nature of those businesses, okay, into really following their path, vision, and direction.
Right.
Now, 5 years down the road, to address your question head on, yes, the percentages that the businesses, I won't comment on the corporate structure because there are oftentimes many other considerations for the corporate structure.
Yeah.
But what I will comment on is the face and nature of the company. Today, the revenues, the majority of revenues come from our sugar business. Over 90% of revenues come from our sugar business. In a 5-year time horizon, this will change quite dramatically, where, of course, sugar, which includes the manufacture of sugar and ethanol and alcohol, will account for a significant amount of revenues, but it will also, the engineering businesses will also be very significant, and certainly not single digit. So we're seeing much higher levels of growth and forecasting higher levels of growth for those businesses. One other point I'd like to make, Sanjeev, is that in a 5-year time horizon, I wouldn't even consider sugar to include ethanol. Ethanol by itself, or alcohol, let's say alcohol, the distillery business by itself will be a separate vertical. Right? Today, there are many things that get intertwined, because you use material that comes from the sugar factory to manufacture alcohol and ethanol, the molasses or the cane juice, as the case may be. In our case, it's just molasses. Next year, we're going to experiment with juice. But in the 5-year time horizon, half a decade time horizon, I think these businesses will be much larger. Of the investments that we've made in our distillery business, what we've announced publicly. And with those investments, the business itself, the distillery business itself, will be a 1,500 crore business. So that becomes quite sizable in its very nature. This is after everything is in place and has been implemented and commissioned. And of course, you've had a full year of operations. So yes, very different face and shape of the organization in the near future.
Yeah, sure. So, we'll come to sugar business because that's probably right now, at least the key driver of the company, and, lots of interesting stuff happening there. But let's talk a bit about the water business, because that's always been a huge potential business. And, if I go back to most of your annual reports last 10 years, you've talked about this huge potential of water. It's still kind of small, but looks like things are happening there. So, and even export opportunities coming up. So maybe if you can just tell us what's happening on that.
Sure, absolutely. So, it's a business that was impacted by COVID, Sanjeev. Let's be very candid about it. The project work that was happening at sites obviously had to stop because of safety precautions that we wanted to take to ensure the safety of our employees as well as our subcontracted partners. And therefore, there was a little bit of a hiatus. Concurrently, the government offices were pretty much shut down for new projects and the opening up of new tenders, and even the discussions for new projects that should have happened a few years ago. They were all delayed because of COVID. We're seeing that changing quite a lot. So you're right. We're starting from a small base. Last year, there was a significant bump up in our revenues as we crossed the 300 crore mark. It also signaled a huge change because it was a profitable year for the business. And the legacy issues that we were dealing with in the past and the transition that we made from working with private industry as well as public industry, that transition was pretty much over. So, we're starting with a very strong base and from a very healthy level. 2 or 3 very important points to consider. Number one, The PQs, you have project qualifications that are required. The PQs are very much in our favor. We're one of the few companies that has PQs across the board, across varying technologies. And therefore, for the future, our ability to participate without technical support or partnerships, right, or joint ventures with other companies, which is a typical way of doing this, is much stronger and much higher. It obviously means that we're better positioned and we can look forward to higher margins. Otherwise, it's always a division of profitability the moment you keep bringing in other partners. The second and very important facet is that we have grown the organization quite strategically from an HR perspective, from a capital allocation perspective, and from a business strategy perspective. From the HR perspective, we managed to retain and hire high quality talent in an industry which has pretty much stayed at a very state of limbo through these COVID times, at least a year and a half to 2 years. And so tenders have not been finalized, people have not been attracted because the opportunities really haven't come up with the bang that is expected. Now, water is a problem across the country. We know exactly what it is. We have the NGG that is in its wisdom, talking about this issue day in and day out. It is going to be a problem. Climate change is going to further exacerbate the water problem in our country. And so as a business opportunity, it is a significant one. And one that we really do see growing. The next element of it is really about being able to tender and to be able to participate in a wide variety of tenders. Now, that ability places us in a very unique situation. The question, of course, there lies is that, are the tenders coming up? Are they coming up with a sufficient pace and a sufficient momentum that you can keep an infrastructure business like water rolling? Because you don't want to have periods of hiatus. You're hiring highly talented people. You want to keep everybody employed, working in one singular direction. It's a very important facet to this business. And I see that concept changing. It's changing from the central government level. It is certainly changing from the state government level. There is, however, one challenge, Sanjeev, and that challenge is about funding. Now, municipal authorities and a few state governments do have certain challenges in terms of funding. And this was apparent 2 to 3 years ago. And I alluded to this in some of the earnings calls that I had with our investors, etc., that we are seeing some delays in terms of project finalizations. That doesn't mean that we're going to win the project. We're certainly going to try hard to win the project because all the projects are awarded on an L1 basis. But the challenge, of course, is the project coming up to finalization? Because if there isn't financial closure, it makes it very, very difficult for municipalities, district authorities to be able to close it. Yeah. The central government has, however, shone the light on this. They've introduced a very powerful public-private partnership model, which I'd like to refer to as a HAM model, hybrid annuity model. Yeah. Where, and you're of course familiar with it, so I won't go into details of how a HAM model operates. But one of our most subsidiary company of TRIVENI Engineering called Mathura Wastewater, where we're actually doing a Namami and Gange project under this HAM model, and there you look at better profitability, certainly better EBITDA margins. You look at faster returns. You look at greater security of cash flows, which is very important for this business. And all in all, it's a godsend. So if we do see, and I think that the central government is talking about pushing HAM models out across the water space. And if we see that happening even at the municipal and state government level, you'll see a lot more traction. You are already seeing more companies that are new to the water space, but you will also see more projects. There's no point just seeing more companies excited about the same number of projects year in and year out. Lastly, with respect to TRIVENI in particular, we won some fantastic projects recently. We won a superb engagement for the government of Maldives, where we're a $25 million engagement with an O&M parcel as well, where we're going to be building water treatment facilities for an atoll of 6 islands. Highly complex project. The engineering has all been done in-house. And as you can imagine, if we can do work, it gives us a great deal of comfort on 2 fronts. Number one, the ability to do a project abroad. And so you're opening up your canvas, not just domestically, but also looking regionally, certainly, to be able to take on projects. And number two, the complex engineering of setting up these water treatment plants, looking at atolls. The engineering required is fairly sophisticated, and there are a few companies that can do it. So we're delighted that we were awarded that project. We've recently won a project in Pali in Rajasthan. It's a 170 crore EPC project. On the back of that, there's about a 550 crore O&M contract, which is spread over 15 years, so a much longer period of time, for effluent recycling. Highly complex. We're dealing with complex effluents, and the ability to be able to actually deal with it, etc., is a feather in our cap that we were awarded this particular project. So, all things are sort of lining up. I'm probably going to repeat a lot of this at our next earnings conference call, but it's exciting because it is exactly what I've been talking about for a few quarters, and it's coming to reality now in a post-COVID world.
Sure. So in terms of capital employed, if I look at it, do you think water will you'll put slightly more disproportionate amount of capital employed in water, or it's going to be much more asset-light model? How do you see that?
Sanjeev, it's a fairly asset-light model. At the end of the day, the hybrid annuity model means you're splitting the equity portion with a potential partner, with a government partner. You get great funding for these projects, and the cost economics work out with the funding in place, obviously. We luckily, because of our debt ratings, etc., have access to quality funding at very reasonable rates as well, and so it further enhances the profitability projections on any of these projects. I don't see a disproportionate amount of capital going into water, and the reason for that is simple. We are at a juncture right now where all the business in proportion, not in an aggressive proportion, but in their own portion, are looking at capital being deployed within themselves. Sugar has got ethanol demands, other associated demands. PTB business has got growing demands on that front, etc. Capacity, marginal capacity additions, etc. And water, of course, requires equity for new projects.
Right. Sure. So let's come to sugar business, and maybe Rajesh can later discuss the other businesses again. It's very intriguing. I was going through the oldest report that I could see was 2002-2003 annual report. And I can quote from there that with the recent liberalization in fuel policy, there's a movement of sugar factories to become agro-complexes. That's what you've said over there. And you've talked about how this is the most exciting opportunity and great opportunity to produce ethanol for mixing with petrol, right?
Yes.
I think this is 2002-03, and now we are almost 19 years down the line. And of course, there seems to be a round two of this happening now, where it's the same government, but it's kind of taken long time for this to really now take it to the next level. So if you just see, that time, what didn't happen versus now what is happening now, which is making making everybody so much more excited. That time it seemed more like a concept which never kind of really took off in the way one would have thought it would have.
So different time, different place. The comment that you're referring to also alluded to cogeneration, which was a sunrise industry at that point in time. It's no longer sunrise. In fact, with so much clean energy, the rates for PPAs for co-generated power from bagasse are actually declining, and the demand is declining because it's seasonal power in any case. So the concept of an agri-complex still remains. I still think we're barely scratching the surface, Sanjeev. There's so much more that can be done, and hopefully we'll be able to talk about what I mean by that during the course of this interview. But let me talk about ethanol directly. In 2002-03, at that point was the birth, it was the genesis of the biofuel industry in India, not in the world. Brazil had already made huge inroads by then. Okay? Even the United States had made inroads at that particular point in time, as with a few other countries. The point was the technology domestically was unproven. There weren't that many companies that had the technology to set up the plants, sophisticated plants. And the concept of blending with petrol was one that was not nationally mandated. It was always a desire. We will work in this direction. The question and the difference of what has transpired and the questions that have been answered in this 15, 18-year time period, 20-year time period, are very important to consider. Number one, it's been leadership and stewardship from the very top. The Honorable Prime Minister is the one who, on World Environment Day, announced the policy for E20 by 2025, accelerated it by 5 years. That's huge. It's massive. When you have policy advocacy from that level, the dominoes fall into place. Everybody lines up in terms of ensuring that we are able to achieve it. Private sector has to line up its investment. The government has to ensure that the policies are there to ensure that the investment happens. Because if you're not making a reasonable rate of return and you're not having assured profitability, then why would anybody from the private sector invest in a new ethanol plant? Okay, so one is about stewardship and policy making from the very top. The second element that has changed is that there have been subsidies that have been given. So if you are setting up a distillery to manufacture ethanol, you're being given subsidized loans. So the loan amount is subsidized by the tune of 50%, which is a very substantial subvention, very substantial. You're getting the money very easily. Okay. Now there may be some mixed debate that some of the sugar companies have poorer balance sheets and therefore they don't get it. Well, fair enough. That is what it is. But honestly speaking, the capacities that are coming up across the country by, let's say, some of the larger players are more than enough to take care of the product that they produce themselves and to buy from outside. So there is no question that capacity won't come up. The next very big difference that has happened today, Sanjeev, is that there are state governments that have announced fantastic policies. Yesterday, I was chairing a seminar on bioethanol, and it was fascinating. Actually, it was a few days ago. I'm the co-chairman of the CII National Committee on Bioenergy. And one of the subjects that we were keenly discussing was the state's role in making this happen. And a lot of people believe it's just the central government. It's not. It's also the state government. The state governments have started playing a critical role in terms of attracting investment. Let me give you an example. Case in point, the Bihar ethanol promotion policy. It's unbelievable. The additional chief secretary who was speaking at that session talked about 300 MOUs being signed. Now, he of course knows the 300 plants are not going to come up, but the fact that they've been signed is exciting. So, all of these very important things are important in terms of creating an investable ecosystem. And it is one that you have to recognize where the pricing is set only annually. You don't have long-term contracts. Okay. And the prices are established by the government. So it isn't some sort of price bargaining system or any other price discovery system. It is a unilateral decision that is taken by the central government once a year for a period of 12 months. So despite that, and I think that will have to change if this is to truly become a sustainable industry going forward. And I believe it will change. Let me assure you that my personal view is that it will certainly change, is that you have longer term possible horizons for policies. And I think that is the future for ethanol.
Sure. No, in fact, you've raised a very important point, which I was going to ask in terms of pricing. So, of course, right now there's huge excitement and a lot of people are setting up distillery, whether it's, sugar-based or grain-based and so on with this ethanol policy. But as you said yourself, on the cogen side, that looked like a great opportunity. A lot of people did that. But then, last couple of years or last few years, we are having some problems. Some states saying, this pricing is not right. And there are disputes going on and so on. Do you think that, 3 years, 4 years down the line, that's a possibility that, the pricing is maybe are like 3 years, maybe. So, you can probably get your payback by setting up today. But just from a longer term perspective, while you just said that, maybe if you can just talk a bit, what gives you the confidence that, there will be, policy continuity?
So you're talking about cogeneration in specific. You cut out for a second, so I'm going to sort of.
What I said was cogen. Yeah, I said you had cogen problem. A lot of states are now disputing some of the rates. Whereas as you said, this is a unilaterally decided rate for alcohol, for ethanol at this point of time. And 3 years down the line, what stops government from then saying that now all the investments are done. You guys are fine. Now I don't want to be so remunerative anymore.
So you got to have substitutes. Okay, I think you have to have substitutes to be able to do that in the cogen ecosystem. By the way, cogeneration is still today a very profitable industry.
Sure.
If there's a sugar factory that doesn't have a cogeneration plant, you can still get a very reasonable PPA. Fine, you won't get it at the same rate that you got it a few years ago, but you still get it at a very, very good rate, and you'll make a fantastic IRR.
Right.
The equity IRR will be unbelievable. Plus, you have a 10-year tax holiday, right? So your ATIA exemption is also beautiful in terms of ensuring your profitability of a cogeneration plant. So I think it's still attractive. For TRIVENI, all of our tax benefits are over. We've been operating these plants for a long time now.
Sure.
So we've now come to the bottom end of the rates. And so I'm giving you a sort of a developed cogenerator's perspective.
Sure.
Right? However, to address your question about policy vacillation, price vacillation in a few years' time, these, we're all in business because we've made educated guesses.
Yeah.
And we made educated decisions. The wisdom today points towards a scenario where biofuels are going to play a increasing role in India's energy security. There was huge talk about EVs and everything going towards EVs, etc. But over the next 10, 15, 20 years, the story for ethanol is far more compelling than that for EV. Here is the challenge that the ethanol industry does face, Sanjeev. And it's not about the pricing. Pricing can come up, can come down, etc. There'll be other considerations for that. The issue that I'm alluding to is that right now ethanol is being blended only in petrol. Yeah. We need a viable solution for a large energy consumer, which is our diesel consuming vehicles. So blending in, for 20% blending, Sanjeev, as you know, reduces greenhouse gases, GHGs, by 16%. Can you imagine the impact of what happens when we start doing this with diesel? And biodiesel or blended diesel are technologies that are currently being worked on domestically and internationally. And when that happens, we will have a very unique marketplace that can't simply be changed. Because frankly speaking, for transportation networks, etc., we are some while away to substitute everything by EVs.
Correct. A fair point. I think point. So in terms of, you guys have also talked about alcohol, like Indian-made Indian alcohol and then Indian-made, IMFL as well, as one of the strategy. Not everybody's talking like that. What is your strategy there? And it seems like you're also planning to have your own brand and so on. So if you can talk us about that, it'll be great.
Sure, Sanjeev. So yes, we launched IMIL, a country liquor portfolio, in December of last year, and we've grown quite well. In fact, we're ahead of our budgeted estimates in terms of our growth. We're having more lines that are added, etc. It's a low margin business, yet we are able to use what is reserved molasses internally, and therefore there's an opportunity cost that comes into our books, which is advantageous to us. The strategy for the IMIL business is certainly to grow it. There is a huge opportunity, Sanjeev, to be able to create brands and to create customer recall in a place where it really hasn't been experienced. Okay, the real estate on a country liquor bottle is absolutely small. There's very little that you can do. It's controlled very heavily by excise, but there is some possibility. Obviously, whatever exists, there are colors, there are branding, there's images, etc., that can be utilized. I firmly believe that rather than having a supply push scenario, which is what has existed in the largest country liquor consuming state of Uttar Pradesh, there's a huge opportunity in the future to create some demand pull, to create customer recognition, etc. It's not that it doesn't happen, but to happen at a different level. And that belief is one of the beliefs that has inspired me to enter into this business. And we have done well in terms of our relatively short stint in this particular and competitive business. Moving towards IMFL, IMFL is not utilizing spirit made from molasses. If you really wanted to look at the more profitable segments of Indian-made foreign liquor, you're looking at grain-based spirit. So we are also setting up grain-based distilleries. In our distillery expansion, as you know, we're expanding our 320 KLPD facilities in 2 stages, finally up to 660 KLPD.
Correct.
Out of that 660 KLPD, a small portion of it will be grain-based.
Yeah.
And the other portion will be flex. So we'll be able to take dual inputs. But that is for ethanol. The smaller portion, which is grain-based, which can either make ethanol or make spirit, ENA, etc., can certainly be used in terms of conversion into IMFL. The branded space offers great opportunity in India today in terms of developing a unique B2C customer experience. For us, it is a logical step forward in terms of establishing a B2C footprint in typically what is a B2B company. IMIL was the first step. This is a parallel and a consecutive step in my opinion.
Sure, but B2C is a very different ball game, right? In terms of in terms of the whole marketing and So what's your thought? You think how would you do it organically, or you want to plan and do some big bang at some point of time?
Well, I think I can't comment on anything that is non-organic at this particular point, but we're certainly going to look at it organically. And we're still some time away. Any launches will be in the next fiscal year, at some point in the next fiscal year. It's not going to be now. So there's a lot of planning and development that is underway. And we're going to see how that goes. The learning and lessons in the IMIL experience are going to play an important role. Plus, we've also initiated franchise bottling very recently, and that too will assist us in terms of our journey into IMFL.
Sure. Thanks, Tarun. I'll hand to Rajesh to ask more granular stuff. I just wanted a bit more strategy kind of questions. So, thanks for all.
Pleasure, Sanjeev. Pleasure.
Rajesh, over to you.
Hi. So I think I'll take off from where you just talked about the IMFL business. We've seen one company in the sector, I won't name it because you know the company, where the return ratios are substantially lower than its peers because they have a high exposure in the country liquor segment. A company operating in the same area as you are operating, that is Western UP. So given that our company enjoys fairly high return on equity as of now, won't entering into that business where brand building and marketing is such a big factor dilute a return profile to a certain extent?
I don't think so. I don't think this is from a EPS perspective. I don't see it being contrary to the strategy that we have in place, Rajesh. You are absolutely correct about country liquor, because country liquor is very, very low margin. But our foray into country liquor is to a certain extent. Frankly speaking, you have to look at it from the opportunity lost. What would we do if we didn't manufacture country liquor? We would sell country liquor molasses at the established prices, which are significantly lower than the free market transfer price, which we would use if we were to make country liquor. So you may not get the eventual margin, but that is because you are transferring the price of molasses at a much higher rate. So you are capturing a lot of that profitability in-house, frankly speaking. The second,
if you could give us the data on that, the transfer pricing of molasses for the alcohol and the current rate for the molasses paid for the 16% captive, which is required in UP?
Well, the rates for captive are 125 rupees per quintal.
Okay.
And the free market price changes quite dramatically. It changes from 300-400 rupees to 500-700 rupees. The blended average over the course of the year would be somewhere around 475 rupees per quintal in Uttar Pradesh, maybe 450 rupees. So let's say it's a 3x at least, more than 3x difference, which is a fairly significant difference, frankly speaking. And the ability for us to manufacture, you see, it's a step process. You take molasses, you manufacture ENA. You take the ENA, then you bottle it, you add the flavorings, etc., dilute it, and sell it as portable liquor. That multi-stage process, you're capturing value across across the board. You also have contribution margins across the board as well. And all of that helps the equity, the profitability of the business. Now, you're looking at it in terms of dilution. And frankly speaking, the moment you look at IMFL as an addition to the portfolio, it compensates for the margin loss in IMIL. However, these are startup businesses for us, Rajesh. So to take comparisons of how we do in this particular business in fiscal 22, fiscal 23, maybe even fiscal 24, may not be representative of a steady state business. Because it is, we are sort of new entrants into this business. And I think the questions then to be asked, maybe not now because we're not, we don't have a portfolio in IMFL, but the question once we're in there is that what are those aspirations in terms of margin, in terms of revenues, et cetera, et cetera. It's too early to talk about that right now, Rajesh.
I understand. But if you get into a little bit more granular in this, is grain-based ethanol more profitable or selling ENA to the IMFL companies more profitable?
It's not an apples to apples comparison. Grain-based ethanol has its own set of economics. It is not sold as a substitute for country liquor ethanol or country liquor molasses. Country liquor ethanol, country liquor ENA. Country liquor ENA and grain-based ENA are two different animals. A grain-based ENA goes only for portable liquor. ENA made from molasses, if it's made from molasses that was intended for country liquor, is sold then to country liquor manufacturers. Molasses-based ENA, which is used for bottling purposes, then can go for IMFL, rums, etc., etc., etc. The economics are very different, and they depend on the price points of what you're getting a feed material at. I gave you an idea of the feed material for molasses, but grain has been equally competitive, especially because we have national godowns that are overflowing with rice and split rice, etc., both of which they can be utilized for the manufacture of grain-based ENA as well as grain-based ethanol.
No, I understand that. I was actually referring to it from the additional processing cost, etc. Whether being in the ENA business, along with alcohol, obviously, is a better business strategy than to get into these things.
Well, my question is, why would you look at it as substitutes? Right? The cost of setting up new additional capacity isn't enormous. We're setting up a 1,500 crore business by doubling capacity, and we're spending 350 crores. The return on the revenue multiples are amazing, Rajesh. So, as an entrepreneur, I wouldn't look at it the way that you've just said it. I would look at it as two discrete businesses. Do they make sense on a standalone basis? The risk protection and mitigation that you have is that there is fungibility. So, for example, you have a processing plant that can make ethanol, which is denatured spirit, and it can also make ENA. And something in the future happens to ethanol prices. Well, guess what? Because you have that flexibility in-house, you divert everything and you make ENA, and you sell ENA. You may not be able to consume it all in-house, but you have other options. You have the chemical industry, you have other potential industries that can be sources and buyers of that end product. So having that fungibility is important. In fact, it's a central part of our distillery strategy. Our new manufacturing unit that is coming up in Milak Narayanpur, 160 KLPD plant that will be operable in January of 2022, is going to be the first plant in North India that can use juice as well as grain. And the added advantage of that is that you look at the pricing. We will make ethanol. We will supply ethanol. There's no question about it. But we have the benefit of being able to flip to another raw material based on profitability.
I understand that because I don't know whether you'll agree with me, but on simple calculations, the B heavy route is still much more profitable than the juice route in terms of a payback period. If you don't use grain on the 6 months that you're not crushing.
Correct.
Unless you use some other, yeah.
Yeah.
So if you
So-
just take the standalone economics, juice is less profitable than B heavy, but still everybody wants to get into juice. So that was actually my next question. So unless someone has an option, yeah.
Let me answer that. So there are two ways of looking at it. Okay, one is the simple comparison which you've made. Okay, actually you've asked and answered the question yourself. I'm simply going to put some more words to it. Okay, Rajesh, at this point in time, B heavy is definitely more profitable than juice. There's no question about it. But what happens when you use juice or cane syrup? Okay, there are 2 or 3 things that happen. B heavy is just a cut of molasses. Your crushing capacity is stable. The moment you use and process juice or syrup as the entry point into your distillery, you can actually extract more from the milling tandems. So you can crush at a slightly higher rate, up to 5% higher in a well-run plant. So that means your throughput, your daily throughput becomes a little bit higher. And there are certain advantages to that as well, obviously. And it's also, there is a little added profitability based on that. The second and important part is that ethanol that is made from juice or syrup gets the first priority in the tenders, which means if you make it, you get allocated. You can get allocated to the closest depots. And the arbitrage on transportation then lies in your favor. So you make additional profitability compared to B heavy on that front as well. Okay. Now I don't have all the numbers off the top of my head for you because I didn't think we were going to get that granular. But I'm sort of trying to give you a general sense about this as well. The second thing is, it isn't a fair comparison, as you very rightly pointed out, to compare juice and B heavy distilleries. A juice distillery will always be higher because you're setting it up to process more material. A B heavy based plant will be slightly smaller. There are cost economics in favor of setting up a larger plant versus a smaller plant. Let's say X size plant costs 100 rupees. X divided by 2 plant is not going to cost 50 rupees. It's going to cost you 65, 70 rupees. So there are economies of scale in terms of building a plant that are in your favor as well. From a project cost perspective. And lastly, with a juice plant, if you set it up with the fungibility of using grain, the returns, because of the bolt-on grain portion, we keep calling it in the industry a bolt-on grain portion, the cost economics of the bolt-on grain portion really work in your favor in terms of enhancing the profitability. At TRIVENI, I want to just add as a caveat and just a little bit more. My personal view has always been on looking at projects from a return on equity perspective. The industry went through a tough time about 8-9 years ago. You know, there was continued pain for many years. It's not as if we didn't do small capex projects, we did it. But I was very keen that we looked at paybacks because the time horizon was very short. Policy was changing so much. It was very disturbing and there were losses, etc. And I was looking at returns of 24 months for small capex projects. Today, of course, the horizon is longer. I would look at 4 years or 4.5 years at a maximum in terms of cash break even for projects. But as one does that, and we're still evaluating and we're investing in a juice distillery with a bolt-on grain option, you know what, we can certainly meet those profitability criteria.
So that means anybody who is setting up a grain-based distillery plant standalone has a much lower chance of succeeding in this than a sugar mill who can actually use juice for the period it gets the juice and grain for the balance period. So in effect, we should see most of the distillery expansions happen to the sugar sector, or there'll be standalone grain-based distillery as well. I just want to know your thoughts on this.
I don't think so. I think it will have to be both. And the reason, Rajesh, it will have to be both is because we don't have equitable blending happening across the country. You have state policies that I talked about in a little bit earlier in this conversation that will also play a role in terms of enhancing investments within grain. The sugarcane sector, the sugar mills, will all approach new capacity addition with open arms. You're getting great loans. You get the ability, the state governments are supporting you in terms of getting quick pollution clearance permissions. etc., etc. Getting the projects off the ground. You're being able to utilize utilities from your sugar mill, and so there are, to some extent, it's etc. Provided you have the land, etc., and you have a joining factory. And so there are great advantages there. Grain has its own set of advantages. I think standalone grain plants in non-sugar producing states is a fantastic idea. Absolutely fantastic idea. The interesting thing is, and in fact, even in newspaper articles, you've got the oil marketing companies talking about record sizes, 500 KLPD plants. These are huge plants, the type that they have in Brazil, coming up. And in fact, actually, 500 KLPD would be a standard size if the juice program actually becomes a way of life. Converting juice to ethanol becomes a way of life. These 160 KLPD plants we're setting up are simply not enough. They can't take all the juice of that plant on a daily basis, Rajesh. You will need capacities 3 times that size, not 3 times, twice that size for the type of plant that I'm talking about, which is a 5,500 TCD facility. And so if the cost economics work, you're going to see larger plants come up within the sugar sector, and certainly towards the size that we're looking at from the grain-based players. The grain-based players are looking at it from an economies of scale perspective. They want to have a depot that's close to surplus grain production, so that they maximize the transportation advantages, and they're able to supply to states where otherwise they'd have to secure ethanol from greater distances. It works out for everybody.
And in terms of getting to our turnover of 1,500 crores in ethanol, obviously juice is going to play a large part in that, because the realizations are far higher in juice. So would you be entailing sugar sacrifice from the core sugar business for that part, or do you hope to get additional yields or area under cultivation to reach there?
This is not going to be with any significant sacrifice of sugar, Rajesh.
So what, you're going to be having more area under cultivation or better yields?
We are certainly looking at higher yields over the next few years. There's a lot of cane development activity underway in terms of doing that. You will see next year some marginal expansion, tinkering of capacities that happen so that we can enhance our throughputs through the sugar factories. And therefore, the sugar balance will remain unchanged over that period of time. And all the extra portion will go towards ethanol production.
Because we've seen that overall production in UP sometimes get impacted by either some virus attack or something like that. Which
it's still there. Rajesh, it's a very distinct worry. You're opening up a Pandora's box by asking that question, actually.
Yeah, exactly.
This morning, I addressed something called Sugar Tech. And we had the cane commissioner of Maharashtra, we had the additional chief secretary, government of Uttar Pradesh, we had JS Sugar on that in the program. It was the inaugural session. I was also invited to speak with these gentlemen. And we did talk about the problems of a disease called red rot, which was prevalent in East Uttar Pradesh. There are sightings of it in central UP and portions of West Uttar Pradesh as well. We know this disease. I know this disease. It came and hit a fantastic variety called COJ64 20 years ago, decimated that absolute variety. And then we suffered because we didn't have a replacement. This time around, there's been sufficient amount of work done to be able to develop other replacements. Certain factories of ours, for example, our unit at Chandanpur, Rajesh, has 40% general variety, which gives the same kind of yield and sucrose content. So, we are already pretty far along in terms of our varietal replacement. We're not going to be just dependent on 238 as TRIVENI Group. I can't speak about the industry. This disease is one that certainly signals the downfall of this variety. I can assure you, this variety is on its way out. The question is, who's going to find the right substitutes? And do they exist? The answer to that question, I'll take the second one first, is yes, they certainly exist. There are certain varieties that are even a better sugared and higher yielding than 238. Number one. And number two, as far as who's doing it, we at TRIVENI are certainly doing it. And we started doing it 3 years ago. Because multiplication takes time.
Right, because this is actually a worry for the industry in UP, Because we've seen the yields grow in UP on 238, and now you're seeing 238 on its way down. So the process of transition, will it be a painful process by which the yields will actually come off? Or,
I don't think so. I think the farming community has gotten used to high yields. They will do whatever it takes to be able to protect it. The argument to convince a farmer today to switch to another high yielding variety is much easier than before. Much easier. Yes, the availability of seed of 238 is very easy. It's available plentiful. You propagate a new variety, you have to create seed farms. You have to then propagate that variety. It takes time. There's a 7x multiplication factor that works in the world of sugarcane. And but a lot of that is easily done and underway. The genesis of 238 in North India took a period of 3 years. 3 years is what it took. And very honestly speaking, you're talking about yields and a farmer not switching, etc. We're still not getting perfect yields from 238. In the areas where TRIVENI buys its sugarcane from, 238 can give yields as high as 1,200 quintals, 1,300 quintals per hectare, whereas the average yield is somewhere close to 700. So look at that huge difference between what the end is and what is actually possible if you have planted at the right depth, if you have the right row spacing, if you have treated the seed with moist hot air before planting, if you have applied the right amount of nutrients and you've taken care of the soil balance. But think about it, with a little bit of extra effort and a little bit of extra financial effort, you are able to suddenly bump up your yield by 70%. That's all profit.
Right.
Now, it can't happen across the board. These are test projects, etc. But I'm saying you can still go up very easily by some. You do 60-70% of the effort, you'll be able to get 60-70% of the yield enhancement. So those things are possible, despite small land holdings. And that is the future for those firms, including TRIVENI, that spends money on cane development, on hiring the right people, on partnering with and training our farmers, on looking at technology. The next big area is going to be technology-led cane development, looking at, although the regulations don't allow it, and I'm certainly battling for it, looking at drones to spray fertilizer and pesticides, looking at drip and spray irrigation rather than flood irrigation that happens. It happens more so in South India, and less so in Uttar Pradesh, but it still does happen quite substantially. And flood irrigation, again, is a great cause for spread of red rot, Rajesh. So, you prevent all of that by this. Then, of course, the great amount of work that has been done across our factories with respect to soil mapping. You get that soil quality sorted out. It takes a few years to be able to do it. But once you've done it, you can then reap those benefits for 10 years.
Right. So I think it's heartening to hear that TRIVENI is, I think, working along those lines to create an ecosystem for us that will not be disappointed with the yields or with the overall sugarcane availability in terms of our expansion plans. I'm sure that there will not be any disappointments for us to meet our expansion plans as well as the sugar quotas that we are currently fulfilling. Is that correct to assume?
It's a very fair assumption, Rajesh.
Okay. So I would, I think we're running out of time also. So I'd like to ask you one question, which is a common question now for all investors. With the UP SAP hike, we have not seen a commensurate hike in the MSP. While that may not be worrying in the interim because the prices are higher, it is a worrying for the investors in the long run, because suppose the cycle were to go in the other direction, then we have a cost of production which will be touching 34 for some players as well. So if the reverse cycle happens, then all the sugar business will go back into losses, what we have seen earlier in maybe 2017, 2016, that kind of scenario playing out. So I wanted to know your thoughts on that.
Yeah, it's a good point, Rajesh. The industry has been battling for a hike in the MSP, and the hike has not happened despite 2 increases in FRP. So let's not associate SAP. SAP is a state-based phenomenon, but there have been 2 increases in FRP that have not resulted in an increase in the SMP for the minimum price for sugar. I see that happening straight around after the UP elections. I don't see it's a problem then. Prices are high, Rajesh. You're talking about a scenario where there's excess, there's a glut of production, the production can't go anywhere, it can't be evacuated to international waters, and therefore it sits in everybody's throat, and you have a problem. The quota mechanism is a very powerful tool in the hands of the central government to be able to control prices, Rajesh. Very, very powerful. You've seen it in the month of September. They gave a 10% extra release, and prices came down by 2.5% straight away.
But it's again gone back up, the prices, after the SAP announcement.
Not really. I mean, but listen, we're talking about 2 or 3 days. Of course, it's gonna go back to the earlier levels the moment we hit 1st of October. Right. It's a momentary lapse in my opinion. The point is that the government is looking at ensuring and working towards. I think it's a tough ask, and I think there's a lot of work that has to be done to achieve this. But the government is looking at ensuring a 7 million ton closing stock at the end of the next sugar year. So 30th of September 22. To have a 7 million ton closing stock. Now, 7 million tons would equate to just over 2 months of consumption, the festival months, basically, taking you through to the 3rd week of December, pretty much. Okay, that kind of sugar, quantity of sugar in the country is superb in terms of maintaining prices. Now, if the government has very openly talked about it, and I'm quoting the Joint Secretary who said this today. These are not my words. In terms of the target setting by the government. If that is what it is, then the prices that we have today, and certainly I don't have a magic ball to tell you what the prices are going to be 2-3 years down the road in India. We're dependent on so many things. The monsoon is the biggest unknown factor. But when I hear the government saying that, listen, we're looking at 7 million tons, I'm very comforted that the prices that we're looking at today are, number one, accepted by the government. The 38 rupees that you're getting in Uttar Pradesh, which is just zoomed up by $5 in the last 6 weeks, is a price point that is comfortable. It's important, very, very important. The second thing is that it is a price point that could potentially be maintained. I don't think prices will go higher than this. The government will want to let it get higher. If anything, there'll be a downward bias. But how much of a downward bias is what I'm comforted with. So from 38 rupees, even if it comes down to 36 rupees, it is still a 4 rupee, 3-4 rupee, and it takes care of the enhanced increase in SAP. Compensates plus. And so those are
MSP mechanism has to be in place, right? Otherwise, 2 years down the line, when you have signed a agreement with the WTO that you won't be exporting anymore with subsidies, you'll be in a soup, right?
Well, this year we're not exporting with subsidies at all, Rajesh, and this coming year we're not exporting with subsidies thus far. But I think for the full 6 million tons to be exported, there will have to be some support. It's not going to happen on its own. Very tough. About 1.5 million tons has already been contracted from that 6 million tons, but 1.5 million to 6 million is huge. 4.5 million tons is a long way to go. Long way to go. But we're still early days. We're not even the sugar year hasn't even started. So there are still early days, and the sugar season has not started. The point I'd like to make is that these prices are they are sustainable, in my opinion. They're very, very sustainable, and any change in the international markets today, all the bad news was accounted for by international market prices. I think there is potentially further bad news ahead for some large sugar economies, which will then make Indian sugar immediately competitive, and it has the distinct possibility of making UP sugar competitive. Right now, UP sugar is not competitive. So that's what we have.
About 20.5 cents per pound and above. That's like the scenario where UP sugar will become profitable. Yes.
Target is 21.
21. Well, it's not beyond the realm of possibilities given what's happening in Brazil, of course. Yeah, so I'd like to ask a last question and then I'll hand it over to Sanjeev because we are running out of time. So essentially, if you feel that MSP hike is not going to happen now, you are ruling out any possibility of ethanol price hike as well, because ethanol prices, as we know, are linked to MSP and not to oil prices. So since the crude prices have jumped up.
I'm not. I think ethanol prices are tied to FRP.
Okay, yeah, the same. So if I right,
No, it's not
okay,
the same.
okay,
It's not
it's
the
not the
same.
same. Okay, okay,
It's not the same.
okay.
And I think the FRP price has gone up, and I think there's a very reasonable expectation by the industry that there will be a correction. Plus, the government wants to incentivize more plants to come up. For more
Right.
plants to come up, you need to have slightly better rates. Now, the fact that I know that there's no relationship with crude, but the fact that there is a increase in global crude prices is actually couldn't have come at a better time. So everybody can afford it.
Right. So we can conclude, or rather we can assume that ethanol price hike may happen without a commensurate hike in the MSP. Is that right?
I would certainly bat for that.
Sounds good. Sanjeev, all yours.
Yeah, Tarun, if you have 5 minutes, I have just a couple of points, so maybe
Sure.
that's okay. So, I just try to summarize overall, we didn't touch upon many things, but basically sugar with all the policies that the government has made, the profitability seems to be slightly more predictable than what it used to be in the past. And ethanol is going to be the big driver there. So we are all in agreement on that one, right? So how you grow on ethanol is what is going to drive the profitability of your sugar business. Is that right?
Oh, is that a question? Okay. It is
And a question and a statement, which if you agree with that statement.
So I think there's a lot that can happen. I think it's not just ethanol. I think it's the growth of the ecosystem. It goes back to the point of becoming a complex, an agri-complex.
Yes.
Today, the options available to you are fairly large. They may be smaller businesses, but they are certainly profitable and value-added businesses. And I'm alluding to CVG from Pressmud, which is a huge option. I'm looking at using the cellulosic matter, the extra bagasse, if you're not using it for co-generated power, for a whole host of other industrial uses, including packaging, which is an easy thing to do, frankly speaking. And then from the distillery side, you've got pelletization of phosphate fertilizers, you've got carbon dioxide capture, all good things that add quite a lot of revenue to it. Yes, the ethanol story is very compelling, but I think I want to add a word of caution here. There's no point just setting up ethanol capacity left, right, and center. The argument would be, let's just go out and set up ethanol capacity everywhere. And that doesn't hold, because as Rajesh very subtly pointed out, the cost economics are heavily in favor of B-heavy. Now, most of the large groups have already got B-heavy covered. So you have to walk the rope very carefully in terms of other capacity additions and new greenfield facilities that will come up. Where you get your raw material from is a very fine balance that you will have to make. But yes, ethanol will be one of the important constituents for profitability growth in the future.
Sure. And water business, you've talked about in your annual report, some 5,000 crore annual, addressable market for you guys. How long do you think to reach that? Obviously right now it's very small, but what's the trajectory like over the next 5 years?
So I think certainly before the next 5 years, you're going to see 5,000 crores worth of projects annually coming up in India, definitely within the next 5 years, looking at the momentum that's happening across the nation. So I don't think you're going to have to wait for that long. The question really will be, how many new players are there, and will we be able to win the projects as well, is a big question. So we have to make sure that we get our costs correct. We are able to compete technologically and financially to be able to secure projects. So far, so good. So far, Sanjeev, we've actually done pretty well. Last few months, we've got 2 great projects. We're tendering for several more. It seems pretty good for at this point in time.
Sure. And anything on power, any number you want to point out to which can be possible over, again, next 5 years? I'm not.
So we never talked about our power transmission business. It is one of my favorite businesses.
Sure.
And it is so because we have demonstrated blended quarter-on-quarter EBITDA margins in the tune of 30 to 35%, regardless of what the revenue performance has been. That has been the blended performance quarter on quarter. It's a business where we produce product, and we don't sell it based on price. We sell it because we produce it faster and better than anybody else in the world.
Right.
Our delivery times are much faster than anybody in the world, and our quality parameters are as good, if not better, than all of our global competitors. So that is really the premise. Now, the question is expanding that business and finding new avenues for growth. One of those avenues was defense, which is a new business that's been incubated. It's taken 5-6 years to get qualifications, because you need qualifications first to be able to tender. And so we've won a few projects, isolated, nothing much to speak about, because in crore terms, it's still sort of low double digit in crore terms. But I am very hopeful that over the next few quarters, I will come back to the investors and share good news on this front in terms of the projects that we're currently tendering for. Again, it's all on a tender basis. It is with the Indian government, majority with the Indian Navy, who we've had long-term relationships with, supplying gearboxes and other components and turbines as well to the Indian Navy. But it is tendered, it does take time, and so patience is truly a virtue.
Right. But it looks like not many of these businesses will require capital, very large dosage of capital, given that your balance sheet is quite strong and you'll be actually throwing reasonable cash in decent times. What's the thought on balance sheet? Like, what is your ideal balance sheet look like?
So I think we have about at the end of the last quarter, we had a little over 1,000 crores in terms of total debt, with 350 odd crores being long-term debt, and then the balance being short-term debt. The long-term debt is all interest subvened, so it's sort of concessional rates of interest. The projects that we have coming forward, whatever we look at, if we look at additional distilleries, if we look at allocation to water, allocation to our power transmission business, etc., is only going to carry us that way. There are, I believe, going to be opportunities that exist for the company with a strong balance sheet, with its strongest balance sheet, to be able to even explore inorganic opportunities. We have none to speak about today, Sanjeev, but the question is that you really have the ability to be able to evaluate it and move on it quickly when you have a strong balance sheet. We are in that position, Sanjeev. We're hungry for growth, and we're ready for growth. Sure. And we have the ability to be able to grow organically and inorganically today.
But any net debt to equity or a net debt to EBITDA kind of target that you have that you won't go over?
I think we have pretty good ratios. I'm sure Rajesh prints our ratios. Our ratios are our liquidity ratios are pretty good compared to our peers, and certainly to other industries as well. I have we don't have any corporate target as yet, Sanjeev, to share. We don't have a corporate target to share. Yes, we would further strengthen our balance sheet, absolutely, but I don't have a number to give you at this point in time.
Sure. Fair point. Great. I think we have taken a lot of your time, and we could have had a much longer discussion on the power side, especially, and even water. But I guess, maybe we'll leave it for our next conversation, where we'll only discuss these two businesses and not sugar. So thank you so much for your valuable time, Tarun, and wish you all the very best.
Sanjeev, thank you very much. Pleasure talking to you. And Rajesh, pleasure talking to you as well. Look forward to hearing from you at our next call.
Thank you so much. Thank you so much. I shall look forward to it as well.
Goodbye.
Bye.